Assalamualaikum. My name is Muhammad Hairul Hakam bin Muhammad Najib with matrix number 313800, and today I will be presenting my individual critical review for the course Introduction to Management Accounting on the topic of Special Order Decision. The article I am evaluating is titled Relevant Cost Analysis for Special Order Decision to Increase Profit at Winko Babat Lamongan Company. This study perfectly aligns with our topic relevant cost and tactical decision making.
What is special order? A special order is a one-time order from a customer, usually at a price lower than the normal selling price. The company must decide whether accepting the order will generate additional profit. When making this decision, managers should focus only on relevant costs, which are costs that will change because of the special order. Examples include direct materials, direct labor, and variable overhead costs. Fixed costs that do not change are considered irrelevant. Let us look at the case study examined in this research paper. Winko Babat Lamongan, a small to medium enterprise specializing in local food production. The company faced a classic operational dilemma. They received a massive one-time special order for their product. However, the buyer requested a heavily discounted price per unit. The problem highlighted by the authors is that the business lacked a structured cost separation system. They were utilizing full cost accounting, making their costs look higher. The objective of this research was to reconstruct their cost data using relevant costing to see if accepting the order could actually benefit the company. The researchers adopted a quantitative, descriptive methodology to solve this problem. They gathered internal financial data, isolated idle production capacity, and systematically separated the fixed costs from the variable costs. They calculated the incremental revenue, which is the extra cash coming in from the special order, and compared it against the incremental costs, which are the additional expenses incurred only if the order is produced. The findings of the study were highly conclusive. When the irrelevant fixed overhead, such as building depreciation, was stripped away, the true incremental cost of making one extra unit dropped significantly below the buyer's discounted offer price. By applying the relevant costing decision rule, the paper proved that accepting the special order would generate positive incremental profit, thereby boosting the company's net income.
So, in conclusion, this article demonstrates that relevant cost analysis is an important tool in deciding whether to accept or reject a special order. By considering all the costs that change because of the order, company can make better decisions and improve profitability. The study also found that all special orders analyzed were profitable and should be accepted. Therefore, managers should use relevant cost analysis together with qualitative consideration to make effective business decisions. That's all from me. Thank you.
Hello everyone, today I'm going to talk about special orders, one of the short-term decision-making topics in management accounting. By the end of this presentation, you will be able to understand what a special order is, how to decide whether to accept or reject one, and we will look at the real example from a bakery business. So, what exactly is a special order? A special order is a one-time order that is not part of a company's normal everyday sales. Usually, the customer who places a special order offers a price that is lower than the normal selling price. For example, imagine you run a bakery that normally sells bread at 5 ringgit per piece. One day, a school canteen contacts you and says, "Can you supply us 500 pieces of bread at 3 ringgit each?" That is a special order. Now, the big question is, should you accept it or reject it? To answer that question, we use something called relevant cost analysis. Relevant costs are costs that will change if we accept the special order. Things include like raw material costs, direct labor costs, and some overhead costs. Costs that will not change like fixed rent, salaries of office staff, or machine depreciation are called irrelevant costs. We ignore this when making the decision. The simple rule is accept the special order if the price offered is higher than the relevant cost per unit. Also, two important conditions must be met. First, the company must have idle capacity, meaning that it's not fully using its production capacity. Second is, the special order must be kept separate from the normal sales so that the regular customers are not affected by the lower price. Now, let's apply this to a real case. Yudi Shifa Bakery, a small family-owned bread business in Bangkalan, Indonesia. Looking at their data, the bakery's normal production capacity is 6,240 pieces of bread per month. But in reality, they were only producing about 5,000 to 6,000 pieces. This means that they had idle capacity every single month, sometimes up to 621 pieces unused. Now, a customer comes in and offers a special order to Shifa Bakery to buy a bread at 3,500 ringgit per piece, which is lower than the normal selling price. Should Shifa Bakery accept this? Let's look at the relevant cost only. The raw material cost per piece is 2,400 ringgit and 46 cents. Direct labor cost is 256 ringgit and 41 cents. And the only variable overhead, which is electricity and gas, adds to 92 ringgit and 94 cents. This gives a total of relevant cost is 2,749 ringgit and 81 cents per piece. Since the special order price of 3,500 ringgit is higher than the relevant cost of 2,749 ringgit and 81 cents, the bakery will earn a profit of about 750 ringgit per piece from this order. So the answer is yes, accept the special order. You might be wondering, why don't we just use the full production cost? When we include all the costs like indirect labor, machine maintenance, and admin salaries, the full cost per piece comes out higher. Using full costing might make it look like the special order is not profitable, and the company will reject it immediately. But these fixed costs exist whether we accept the order or not. They don't change. So it would be wrong to use them in this decision. This is exactly the mistake Shifa Bakery was making. They were not using relevant cost analysis. Once they apply it correctly, they could see it the special order was actually a good opportunity to earn extra profit from their ideal capacity. To conclude, a special order is a one-time order at a price below normal. To decide whether to accept it, we use relevant cost analysis. We only look at the cost that will change. The decision rule is simple. If the special order price is greater than the relevant cost and there is idle capacity, yes, we accept the order. The case of Shifa Bakery shows us that many small businesses miss out on extra profit because they don't apply this correctly. That's all for today.
Hi, my name is Ibni Abi bin Sabri and my metric number is 313362. Today I will present and critically review an article entitled The Application of Relevant Cost to the Decision Accept or Reject a Special Order, written by Indo Sengeng, Haliaf and Andi Kusumawati and published in 2023. This article discusses how relevant cost analysis can be used to help management decide whether a special order should be accepted or rejected in order to maximize company profit. In business organization, managers often face decision-making situations. One common situation is when a company receives a special order at a price different from its normal selling price. The challenge is determining whether accepting the order will increase or decrease profitability. According to the authors, managers should focus on relevant costs, which are costs that will change depending on the decision made. Irrelevant costs should not be considered because they do not affect future decisions. Therefore, this study examines how relevant cost information can support special order decision at PT Semen Bosowa Maros, a cement manufacturing company in Indonesia. The main objective of this study was to analyze whether relevant cost analysis can be used as a decision-making tool in accepting or rejecting special orders. The researchers conduct a case study at PT Semen Bosowa Maros using interviews, company financial record and production data. They separate semi-variable costs into fixed and variable costs and identify which costs were relevant and irrelevant for special order decision. The study found that PT Semen Bosowa Maros had a large amount of unused production capacity known as idle capacity. The company's normal production capacity was 3 million tons, while actual production was only about 1.79 million tons. This resulted in idle capacity of more than 1.2 million tons. Because the company still had unused capacity, management considered accepting additional special orders. The first special order involved 12,443 tons of cement at a selling price of 1.1 million rupiah per ton. After conducting relevant cost analysis, the researchers found that the company would earn an additional profit of approximately 8.93 billion rupiah. Therefore, the order should be accepted. The second special order involved 19,202 tons of cement at a selling price of 1.08 million rupiah per ton. Although the selling price was lower, the relevant revenue still exceed the relevant cost, resulting in an additional profit of approximately 13.40 billion rupiah. Therefore, the study concludes that both special orders should be accepted because they contribute positively to company profit. Next, I would like to provide my critical review of this article. One major strength of this study is that it applies relevant costing concept in a real business environment by using actual company data, making the finding practical and useful for managerial decision making. Another strength is that the study clearly demonstrates how manager can separate relevant and irrelevant costs before evaluating a special order. This helps readers understand how accounting information support business decision. However, there are also several limitations. First, the study focused on only one company, namely PT Semen Posowo Marus. Therefore, the finding may not be applicable to all industries or organizations. Second, the data used in the analysis were based on information from 2014, while the article was published in 2023. Business conditions may have changed significantly during this period. Third, the study focused mainly on financial consideration and does not discuss non-financial factors such as customer relationship, market expansion opportunities, or competitive strategies. In my opinion, despite this limitation, the article successfully demonstrates the importance of relevant cost analysis in special order decision. The findings support managerial accounting theory, which states that decisions should be based only on cost and revenue that are directly affected by the decision. In conclusion, this article shows that relevant cost analysis is an effective tool for evaluating special orders. Both special order alternatives generate additional profit because the relevant revenue exceeds the relevant cost. Therefore, managers should focus on relevant costs rather than total cost when making special order decisions, especially when the company has unused production capacity.
Assalamualaikum and good day everyone. My name is Imran Faiz bin Fazil Sharir, metric number 313763. Today, I will be presenting an article review related to my assigned topic, which is special order decision on the relevant costs and benefits for decision making. The article that I selected is entitled Strategic Management Accounting and Decision Making in Small Medium Enterprises in Malaysia, published in 2020. A special order refers to a one-time order that is offered at a price different from the normal selling price. Before accepting such an order, managers need to evaluate whether the order will contribute positively to the company's profit. To make the right decisions, managers require accurate cost information and appropriate pricing strategies. Therefore, this article is relevant because it discusses how management accounting information supports decision making among Malaysian SMEs. The purpose of this study was to investigate the relationship between strategic management accounting practices and decision making among small and medium enterprises in Malaysia. The researchers focused on three accounting techniques, namely strategic pricing, target costing, and life cycle costing. Data were collected through questionnaires distributed to SMEs located in Selangor. A total of 113 valid responses were analysed. The researchers wanted to determine whether the use of management accounting techniques could improve managerial decision making and business performance. This study is important because SMEs operate in a competitive environment and must make effective decisions regarding pricing, cost management, and profitability. The findings revealed that strategic pricing and target costing have a significant relationship within decision making. This means that business using these techniques are better able to evaluate alternatives and make informed decisions. The study also found that target costing is the most widely adopted management accounting techniques among Malaysian SMEs. However, life cycle costing was found to have no significant relationship with decision making in this research. Overall, the article concludes that management accounting information is an important tool that helps managers make more effective and profitable decisions. In my opinion, the article has several strengths. First, the study is conducted in Malaysia, making it highly relevant to local business environments. Second, it uses actual data collected from SME owners and managers, which increases the credibility of the findings. Third, the article clearly demonstrates the importance of accounting information in supporting managerial decisions. However, there are also some limitations. The study only focused on SMEs located in Selangor, which may limit the generalization of the findings to other regions in Malaysia. In addition, the sample size is relatively small compared to the overall SME population. Another limitation is that the study discusses decision making in general and does not specifically focus on special order decisions. Although the article does not directly discuss special orders, the findings can be applied to special order decision making. When a company receives a special order, management must determine whether accepting the order will generate additional profit. This requires managers to identify relevant costs, estimate expected revenue, and evaluate pricing strategies. The article highlights the importance of strategic pricing and target costing, which are also key considerations when evaluating special orders. For example, managers need to determine whether the special order price is sufficient to cover relevant costs and contribute positively to profit. Therefore, the findings of this study support the idea that effective management accounting information can improve the quality of special order decisions. In conclusion, this article provides evidence that management accounting techniques play an important role in supporting decision-making among Malaysian SMEs. The study found that strategic pricing and target costing significantly influence managerial decisions, while life cycle costing does not have a significant effect. Although the article is not specifically about special orders, its findings are highly relevant because special order decisions also require accurate cost information and effective pricing strategies. Therefore, management accounting information remains an essential.
Assalamualaikum and hi, I am Muhammad Farhan bin Hashim, metric number 314158. Today I will be presenting an article entitled An Analysis of Sugar Sweetened Beverage Elasticity of Demand in Malaysia, published in the Journal of Economic Malaysia in 2024. First of all, Malaysia has one of the highest rates of obesity and diabetes in Southeast Asia. To address this issue, the government introduced a sugar tax on selected beverage. Therefore, it is important to understand how consumers react when the price of sugar drink increase. This study actually has three main objectives. First, to examine the price elasticity of demand for sugar sweetened beverage in Malaysia. Second, to analyze consumer response to price increase. Third, to determine whether consumers switch to alternative beverage and whether different income groups respond differently. For this research, the author used data from the Malaysian Household Expenditure Survey 2019. They applied the almost ideal demand system, also known as the AIDS model, which is commonly used to estimate consumer demand and price elasticity. The first finding of this study is that demand for sugar sweetened beverage decreased when price increased. This shows that consumers are sensitive to price change. When sugar drinks become more expensive due to the sugar tax, many people reduce their purchase. This finding suggests that increasing price can be an effective way to reduce sugar consumption and encourage healthy lifestyle. The second finding is the substitution effect. The study found that when sugar drinks become more expensive, consumers tend to switch to other beverages instead of completely stopping their purchase. For example, some may choose bottled water or other alternatives. This shows that consumers adjust their buying behavior when price change. The third finding shows that consumers from different income groups respond differently to price increase. Lower income households are more sensitive because sugar drinks take up a large share of their spending. As a result, they are more likely to reduce consumption. Higher income households are generally less Price elasticity of demand measure how responsive the quantity demanded is to a change in price. If the value is elastic, consumers are sensitive to price change. When price increase, demand decrease significantly. One strength of this study is that it used actual household expenditure data from Malaysia, making the finding relevant and reliable. In addition, the study compared different income groups, providing a better understanding of consumer behavior. However, one limitation is that the study used data from 2019, so current consumer behavior may be slightly different. In conclusion, this study showed that price play an important role in influencing the demand for sugar-sweetened beverage in Malaysia. When price increase, demand decrease, and some consumers switch to alternative products, the study also found that lower income households are more sensitive to price change. Overall,